A year ago, Wall Street was writing Alphabet's obituary. AI was going to destroy Google search, ChatGPT was stealing users, Alphabet had lost the race. Now fast forward to today, $110 billion in quarterly revenue, up 22% year over year. Google Cloud is up 63% and the stock more than doubled from its April 2025 lows. So was the AI disruption narrative completely wrong? And more importantly, is Alphabet still a buy at these levels? I'm Edward Kalstian, founder of Egg Capital, where we look for market-beating stocks for the long run. Today, we're breaking down Alphabet through our 5 key factors: economic moat, return on capital, growth, financial strength, and valuation. The moat is always our starting point, because if a company can't protect its profits from competition, everything else is irrelevant. Morningstar rates Alphabet a wide moat, and when you look at what they actually own, it's hard to argue otherwise. Google Search controls over 80% of the global search market, shooting past 90% on mobile. That dominance is built on intangible assets and a powerful network effect. More users generate better data enables better ads fund better search. A self-reinforcing flywheel running for 2 decades. Bears point to tools like ChatGPT as existential threats. But building a competitive search engine is structurally prohibitive. Billions to build, billions to attract users and advertisers, and then to sustain it indefinitely. Microsoft has been trying with Bing for over a decade. Google still owns 90% of mobile search. Meanwhile, AI overviews and AI Moat are expanding search query volume, not cannibalizing it. Beyond search, YouTube has 2 billion monthly users and a content flywheel no competitor has been able to match. Google Cloud benefits from high switching costs and TPU cost advantages. Android powers 2/3 of the world's smartphones in a functional duopoly with Apple. Alphabet doesn't have one moat, it has 4 interlocking ones. Before we get into the numbers, every data point you're about to see, I pulled it from Fiscal. The moat ratings, returns, growth, balance sheet and valuation, all in one place. It's the research platform I personally use for every stock I analyze. Returns on capital tell us how efficiently management turns investor dollars into pure profit. Alphabet's return on invested capital is 33.4% and return on equity is 35.7%. Now if we compare this to peers for return on invested capital, Apple stands at 48.2%, Meta at 28.5%, and Microsoft at 23.9%. Apple looks highest, but that's largely a result of aggressive share buybacks and significantly lower AI capex investment, which frees up capital but reflects a different strategic posture, not superior business operations. Exclude Apple and Alphabet leads all peers on return on invested capital. Now on to return on equity. Apple sits at 171.4%, Alphabet at 35.7%, Microsoft at 33.3%, and Meta at 30.2%. Same story with Apple. The 171.4 return on equity is mathematically inflated by buybacks, shrinking the equity base. Set that aside, and Alphabet leads the group here too. These are real returns from real business operations, exactly what you want in a long-term compounder. Growth is the engine that drives long-term value creation. Over the last decade, Alphabet has delivered. Revenue grew at a compounded annual growth rate of 18.1% and net income grew at a CAGR of 23.7%. Earnings per share CAGR has grown at 25.6%. That earnings per share outpaces net income growth because of consistent share buybacks, amplifying per share returns for long-term holders. Now compared to peers on earnings per share growth, Meta sits at 23.6%, Microsoft at 20.4%, and Apple at 15.3%. Alphabet is the clear winner at scale. Now the question is, can this growth continue? Morningstar projects 18% top-line CAGR over the next 5 years. matching the historical rate. The key driver is Google Cloud, projected to grow 47% annually and represent 43% of total revenue by 2030, up from 15% in 2025. That's a fundamental transformation of the business mix toward higher margin, more defensible recurring revenue. The growth story is shifting from advertising company with cloud on the side to AI infrastructure powerhouse with a dominant advertising foundation. That's a more valuable business. Financial strength is our sleep at night factor. Can Alphabet survive a downturn and keep investing through it? Total cash and cash equivalents sit at $126.8 billion and total debt at $59.3 billion. Total free cash flow sits at $73.3 billion, and this gives us a free cash flow to debt ratio of 103.6%. Alphabet can retire its entire debt in under 1 year of free cash flow. Anything above 10% is considered healthy. This is exceptional. The net cash position is $67.5 billion. Alphabet is a net creditor. Their balance sheet gives them the freedom to invest aggressively in AI infrastructure without any financial risk, a combination that is genuinely rare at this scale. Even the greatest business can be a poor investment if you overpay. Valuation is the final filter for our margin of safety. Alphabet is trading at a forward price to earnings of 30.9. In historical context, the minimum is 15.5, median was 23.5, and the maximum was 34.6. Alphabet is trading above its historical median, closer to the upper end of its historical range. That's worth acknowledging honestly. Now compared to peers, Apple trades at a forward PE of 31.4, Microsoft at 22.5, and Meta at 18.8. Alphabet trades in line with Apple and at a premium to Microsoft and Meta. Given Alphabet's superior return on invested capital and decade-leading earnings per share growth, a premium to those two is defensible, but it does require continued execution. Now the price-to-earnings growth ratio, because PE alone ignores growth. The long-term analyst earnings per share growth estimate is 16%. This gives us a forward PEG ratio of 1.9. A PEG below 1 is undervalued, a PEG between 1 and 1.5 is fair for quality, and a PEG above 1.5 is expensive. At 1.9, Alphabet looks expensive by this measure. The honest caveat is that analyst estimates at 16% are likely conservative. Alphabet has compounded earnings per share at 25.6% over the last decade. If forward growth lands closer to 20%, the PEG drops to 1.5, right at the border of fair for a wide moat compounder. Alphabet stock has a wide moat, best-in-class returns, and decade-leading growth. So is it a buy at these levels? Let's bring this together through our 5 key factors. Alphabet has a wide moat, 4 interlocking competitive advantages that have survived every disruption narrative thrown at them. Returns on capital are best in class, with a 33.4% return on invested capital and 35.7% return on equity. Growth is exceptional, a 25.6% earnings per share CAGR over the last decade, the strongest in its peer group. The balance sheet is a fortress with $67.5 billion in net cash. But at a forward PE of 30.9 and a PEG ratio of 1.9, Alphabet is slightly overvalued at current prices. So the question is, do you pay a slight premium today for one of the greatest businesses ever built, or do you wait for a better entry point? Drop your answer in the comments.